The result itself was a little bit softer than our forecast, but no doubt a significant improvement on the previous year. And really that's a function of a couple of things, but really mainly higher commodity prices, as everyone knows. They've also done a pretty good job of controlling costs and pulled quite a significant amount of costs out of the business. There's probably less of that to go in future, but that's kind of where BHP is now, and with prices where they're at, they're obviously making pretty good money, but the real question is around the sustainability of that, and EBITDA margins, interestingly, were as high as they've been since the peak of the China boom. Fortescue, that result was pretty much as expected. They've done a really good job of pulling costs out. And the iron ore price has been just phenomenal for them, so it's really helping them pay down debt. So their balance sheet was really a sore point 2 or 3 years ago, and it's becoming on a sound footing. But the sustainability of this level of earnings, particularly when they're exposed to iron ore, is a real question. And you've got the iron ore price is trading well above the support from the cost curve at the moment, and we don't think that's going to continue.
So Woolworths reported its interim results on Wednesday. Key points to take note of in our view were around the supermarkets business, which accounts for 65% of the group's EBIT in the half. The big surprise to the market was the strength and momentum of sales growth that Woolies outgrew the market, and in particularly outgrew Coles. That strong sales growth was very well received by the market, and the stock was up significantly on the day. The other interesting data point, however, in our view, was that EBIT margins for the supermarket business declined from 5.2 to 4.3%, half and half. In our view, long-term EBIT margins for the group sit around 4%, so only 30 basis points lower from where Woolworths currently sits. And this is due to our view on the competitive environment. We'll see a response from Coles in terms of price cuts, which means Coles will try to regain market share it has lost. Also, a second competitor called Aldi is expected to continue aggressively rolling out its stores over the near term, over the next 4 or 5 years, and capturing market share. So given the competitive pressures on the top line, and also likely price cuts from Coles, which might also lead to further price cutting from Woolworths, we maintain a cautious stance on the supermarket industry in Australia.